Hello and welcome to another video as part of the technical analysis series. Thank you for all the support on the trade management video. There's still a few more videos to do, I think, and new ideas keep coming up all the time. So thank you for your feedback, comments, and support. As you can tell, today's video is on first trouble area, the concept of FTA. So let's get straight into it. Here's the outline for today's session. Start with a disclaimer, then some general remarks to set the scene. We'll explain and go through the acronym FTA, what it stands for in its kind of base form. Then we're going to talk about three separate use cases for this concept: profit taking, trade management, and trade entry. We'll then talk about time frames to kind of bring those three concepts together, and then round off with some swing trading tips and clarifications, and then conclude the video. Disclaimer comes first. Feel free to pause the video if you must to read through it. I am not a financial advisor. This is not financial advice. This is for entertainment purposes only. We are here to have a laugh, apparently. So some general remarks. I know I say this given the library of videos we've built and they kind of build upon each other, but I do really urge you to watch the video on time frames and the one on trade management. I take a lot of knowledge from those videos for granted in this one, and I don't have time, and it's not in anyone's interest for me to re-explain in a short time what I've taken time to do elsewhere. So go watch those. It's totally fine to pause this video. Trust me, it will help a lot. The second point, this is one of the more complex topics in the series, but if you're finding bits of it hard to follow, just make sure you stick around. Feel free to pause, but the way it's kind of structured, as you saw in the outline, it's kind of brought together towards the end. So if you're finding stuff tough, feel free to replay it, but it is, given the complexity of the topic, I promise you there is a logical progression and chronology to it. Third point, you don't need to trade support resistance to use this framework, but that's where my experience lies. General kind of price actiony, supply, demand, swing trading, reversal, M&A, moving average, all of that type of, all of those systems, anything to do with turning points in the market really, I think can benefit from this framework. So if you don't explicitly trade support resistance, I'm sure there's something here for you nonetheless. Now, your trading system needs to afford some degree of discretion for the FTA framework to be useful. As you'll come to see, there's a lot of kind of subjectivity and judgment calls to be made when applying this framework. It's not as rigid perhaps as some of the other videos in the series. So if your system's overly strict and you're not willing to entertain some human decision making or discretion, perhaps this may not be extremely useful for you. Final point, small pet peeve, kind of on a humorous note. Thank you to every single person who recommends my content and retweets and engages with it in any capacity. I'm extremely grateful. The only thing that makes me smirk slightly is when it says that, crypto cred videos for it's like a beginner technical analysis series, or to, the basics. I think it's fair to say that, especially with the last few videos we've made, and if you look at the sum total of the material that we've covered, especially the Medium articles and some of the concepts therein, we are far beyond what I think is a basic type of course. So if you're undertaking this, or this is the first video you're watching, there is a certain amount of depth that I feel that we touch on both in the video and the Medium articles as well. And links to all of those, which are all freely accessible, can be found in the description. So acronym explained, let's get straight into it. FTA, what does it stand for? It stands for first trouble area, right? So the definition that I use, and this is our working definition, again, this is one we'll elaborate and build on throughout the video, but just to get the idea in your head, it is the support or resistance structure nearest the price. As the name suggests, right? The first trouble area. So if the market's rallying or if you're in a long, FTA is the nearest resistance structure, right? So the market's going up. Where could it run into trouble? It would be at an area of resistance. And the opposite works as well. If the market's falling or if you're short, if the price is going down, where could it run into trouble or some sort of barrier or things get sticky? That would be at an area of support. So broadly speaking, how is this concept useful? We're trying to ascertain where the market is most reasonably and most likely going to give our trade some trouble, and use that area to manage the trade in some capacity or act on the trade. As you'll see, there are a few disclaimer type of words, such as, most reasonably, okay, and most likely. I'm not just being vague here. The concepts we'll build on throughout the video will complement this, but this is just to give you a working definition before we go much deeper. Okay, so the underlying logic of FTA, generally the market doesn't care about where you entered or where your take profit is. You'll see a lot of traders use arbitrary risk reward, like they know where they want to enter, they know where they want to put a stop loss, but then for a take profit, they'll just kind of move up the risk reward tool until it gives them, 2 reward for 1 risk or 3 reward for 1 risk, just to kind of tick some mental box. The market doesn't work in that way. It doesn't care about the parameters of your specific trade. So what we're doing with FTA is it's a tool for identifying areas where those probabilities may shift unfavorably, and therefore they become areas to pay attention. Again, deliberately vague term, pay attention. As you saw in the outline, that in itself takes many forms, whether that's trade entry, profit taking, trade management. Those are the main 3 we're going to focus on, but we know that an FTA is where we pay attention, do one or all 3 of those things should price arrive at such an area. So let's dive straight into the first use case, FTA for profit taking. So the principle here is that FTA can be used for take profit orders on positions. Just how we said in the introduction, if let's say you're in a long position, you can put your take profit orders at FTA. So in that case, it would be the nearest reasonable level of resistance. And what that means we'll discuss when we get to the time frame section. Similarly, for the short position, take profit orders at first trouble area means take profit orders at the nearest reasonable level of support. And don't worry, for those of you whose eyebrows are raised at the term reasonable, it's not just constructive ambiguity, very deliberate term, and I promise you, just to keep your attention, we will get to some very specific guidelines later in the slides, so bear with me. So what's the underlying logic of using FTA for profit taking? As before, price doesn't care about your entry or your ideal take profit. I'm generally assuming that your position was established at or near a reversal point or some point in the market that you deemed significant enough to take a trade, and therefore the position will also be closed, or perhaps, well in this case, yes, definitely closed because we're using it for take profit orders, or perhaps scaled off or lightened, also at/near a reversal point in the market. Generally, with the FTA framework, your reasons to exit a trade will have some bearing or bear some resemblance to the reasons for entering a trade. Okay, those 2 things are linked, which is where that framework comes from, of entering at support, exiting at resistance, or entering at resistance and exiting at support. So within reason, for that reason, we do not take levels for granted. That is to say, if we're in a short position and price is coming into support, within reason, we generally don't expect, or at the very least, we don't assume that the market is just going to break support and keep going on forever. Okay, that level of support bears some risk of reversal or shifts the probabilities from being very much in our favor to perhaps less so in our favor. And that FTA is a reason to, as we say, pay attention. And again, whether paying attention means exiting the trade, taking some size off, managing it, moving your stop loss, those are all things we cover in this video. So don't worry, the vagueness will certainly be qualified. Now, FTA for profit taking, again, one of the 3 we're covering in this video. It's really as simple as it seems, but some nuances later. You bought support, you get out at nearest reasonable resistance. You sold resistance, you get out at nearest reasonable support. That's the framework in a nutshell. Now, the benefit of doing so is a lot of traders struggle with predetermined trade parameters, especially with regard to take profit. If you're in the green and you knew you want to take profit at a certain price level and you're watching your P&L flicker higher and the market's kind of looks really strong coming into your level of resistance, a lot of awful trade management tends to occur in those circumstances where previously determined or perhaps objectively, quote unquote, determined take profit levels, they're usually worth trusting. Your judgment is probably really not the best when you're feeling the kind of FOMO, the itch, the P&L greed, all of that type of stuff take over, when the market reaches a level that you previously ascertained would be good enough for you to get out of the trade. Okay? And perhaps the most important benefit, as per the last point, is that despite some discretion, what you now have if you use FTA for profit taking is it adds a replicable logic to how you generally take profits in your trading system, which is fantastic. That's what we like. So an example, when we say nearest reasonable level of resistance, again, we'll revisit this when we talk about time frames, but as a basic example, we've got the ETH chart here, ETH USD on the daily. You've got 2 levels. You've got a level of support at 216. You've got prior lows here, a couple of highs, and the breakout level. Let's say you're establishing long positions at or around this area. Again, with all the examples, take them with a bag of salt. I just pick things that I think will best convey the concept. It's never as clear in trading, unfortunately, but as long as you understand, that's fine. And so if your trade is established around the level of support, in this case, where's going to be FTA? Where can the trade run into trouble? Where it's the nearest reasonable level of resistance. We bought support. We're looking at resistance to pay attention, or in this specific use case, take profit on the trade. And the nearest level on the same time frame and close to price is the 230 level again. Previous support turned resistance. And that's a very much basic case of you got involved at a reversal point and your FTA, where is that trade going to run into trouble? Well, we assume it's going to run into trouble at resistance. And that makes the nearest level of resistance a reasonable place to look to take profit in this example. Okay? So that's FTA for profit taking. Fairly straightforward, probably one of the easiest ones, or the easiest one we're going to cover throughout the course of this video. FTA for trade management gets a bit more nuanced here. The general principle is that how price reacts at FTA can generate trade management signals. Okay, this is especially applicable when dealing with large high time frame swing trades where there's likely to be a lot of empty space between entry, stop, and target. So FTA provides a framework to manage swing trades which may have, large percentage gaps between your three trade parameters. That doesn't mean you just enter the trade and you just sit there and do nothing at all until you're either invalidated or the trade reaches profit. By looking at where the first trouble area for that swing position, as an example, lies, we can favorably manage the trade and not let a winner turn into a loser, or even the reverse of that, stop a trade from being a full-size loser into something less than that and protect our equity curve in that manner. Okay, so the underlying logic for FTA for trade management, that if your high time frame swing trade is correct, price should be able to overcome interim and usually lower time frame levels along the way. Okay, and we'll have a diagram here in a moment, but let's just get through the concepts first. A couple of examples conceptually, which we'll draw out shortly. Let's say you're trading from weekly resistance to weekly support, and you can see that echoes the logic we did in the previous slide, where we took a trade at daily, the example trade is buying daily support. We're looking to get out at daily resistance. We have a working framework, as clumsy as that sounds, the price, if we are correct, will travel from one high time frame level to the next high time frame level. And again, if the idea is correct, the levels and the structures between high time frame level A and high time frame level B will be overcome / break if the trade idea is valid. Okay, so example here, if you're trading from weekly resistance to weekly support, which would be a short trade, daily support along the way must break at some point for the idea to be correct. And perhaps an inverse example of that, if you're trading from daily support to daily resistance, which would be a long position, hourly resistance along the way must break for the idea to be correct. Now that's as a matter of kind of necessity, certainly when you're swing trading. So let's take the bullish example where we've got a weekly, let's say, let me lower this mouse DPI, it makes drawing very difficult. Let's say we've got a weekly level of support here, and we're going from weekly to weekly, right? Our FTA is usually determined for our purposes, present purposes, on the same time frame that the trade idea is generated on. So we're going from weekly support to, say, weekly resistance, which isn't unreasonable, okay? And then usually you have a pretty large span of price between two high time frame levels. And it wouldn't be unusual to have, let's say, a daily time frame level in between your swing idea, right? So the swing idea is from weekly to weekly, but that doesn't mean that every other technical structure on the chart just vanishes and you either hold the trade or you get stopped out. If there's daily structure here, in order for price to reach from weekly to weekly, if your trade idea is correct, interim levels or lower time frame levels, given of course the weekly time frame is a greater or bigger time frame than the daily, if price is going to move from here to here, the daily level is going to have to break necessarily, right? So that's kind of the concept being covered there, that in order for that swing trade to materialize, we must assume in some form that if the idea is correct, these lower time frame levels must roll over for price to, as a fact, travel from A to B. Okay, hopefully that's understandable. It will be when we cover time frames. Now, we're talking about trade management. So the question is, how can that middle level, how can that interim level we just talked about help us or generate management signals, as it says in the first bullet point? Well, as you'll see, we're going to talk about if a market fails to break FTA and if it succeeds in breaking FTA, what the implications of that are and what specific trade management signals that might give us. Okay, so we're going to go back to our example in a second, but just conceptually, if a market fails to break lower time frame first trouble area, what does that actually mean? Well, firstly, that's evidence that it's not ready to break out or break down, okay, and will likely revisit entry. It could also be evidence of strength if support is holding, or weakness if resistance is holding, and the signals that those generate is that you can choose to close the trade if you're being aggressive, because you're saying that basically the time frames aren't aligning to reflect the idea of your swing trade, or prepare for a retest of your entry structure, which is your kind of do-nothing conservative model. So with that said, let's look at an example, again, of a market failing to break FTA just on our diagram here. And then we're going to look at a chart example as well. So plenty of stuff to look at. Let's look at it conceptually first. Go back to what we had drawn previously. We've got a weekly level of resistance, which is where we want to take profit. The weekly level or structure of support, where let's say our trade is generated. And then the interim, again, lower time frame usually, daily level, which stands as an obstacle between swing trade entry and swing trade exit, right? This is our daily level. So that daily level that we've drawn is the trade management first trouble area. So you'll see, that this concept is elucidated in the next slide, we have two FTAs at work. The daily level is a first trouble area for the swing trade, but it's something that we can use for trade management, right? Whereas the weekly level on the other side, since we're trading from weekly to weekly, this is still a first trouble area, except it's the first trouble area we're using for take profit. Does that make sense? So there are two FTAs at work. One is the weekly level we've established for our take profit system, which is taken on the same time frame as the trade idea. So there's the first trouble area on the time frame that generated the trade idea in the first place. And then the second type of FTA at work is, okay, so that my swing trade is from weekly to weekly. Where could this weekly idea bump into some trouble? And trouble in this case takes the form of daily resistance or a daily level in the middle, which we could then use for management signals. So bearing in mind the things we talked about in the slides, let's take the scenario where price fails to break FTA, so it comes into this daily level, consolidates, whatever, pokes above it, but ultimately, let's say, starts breaking down in one form or another. I would love if it were this neat every single time, but it often is not. Going back to our slides, what does this tell us? Again, if we're being aggressive, we can pretty much close the trade if FTA fails to break. Because the signal that the market is telling you is essentially that if your high time frame idea is correct, the price is going to travel from weekly level to weekly level. As we talked about in the very first diagram, necessarily that would imply that levels between those two would need to be broken for price to reach the opposite boundary or the next weekly level. So failure to do so is a sign of weakness. Or viewed another way, daily resistance stopping a weekly time frame move is also in itself a sign of weakness, because it's showing that time frame precedence, the notion that higher time frame moves will over time somehow defeat or take precedence over lower time frame moves, that the market isn't quite ready for that stage. Okay, so aggressively, the signal that this failure at FTA can generate is to pretty much close the trade, or if you want to be more conservative about it, the second point we made in the slides is that this is evidence of an entry retest. So what you'll often see is a nice move from the weekly time frame. Price essentially takes a breather at FTA, right? Gets stuck a bit on the lower time frame, bounces, and then either makes a higher low and then breaks through, or maybe retests the level, spends a bit more time there before eventually moving to the weekly objective. Okay, now which of these is correct or the right way of doing things? It really depends, and it's very much context dependent. I wish I could give you a cookie cutter model which had an answer for every single scenario, but the management signals, these two things that we receive, are in themselves extremely valuable. Okay, so hopefully that brought some clarity to those slides. And we've also got a chart example here actually on the Bitcoin Cash Bitcoin chart. And this is something we wrote about in our newsletter, which is free, and we'll talk about that in a bit. So you've got a weekly level of support here, like a huge level. You can see it's pretty much the last level of support, preceded this big move, etc., etc. Let's say you get involved at that level as a buyer. Now, where is your, and this is like a big weekly level, final level of support. You're expecting a big move, so it wouldn't be unreasonable for you to go from one weekly level, well, this really isn't the kind of move I want to capture from the best weekly support on the chart. I want to I think the market's going to move a lot more, so my FTA for profit taking, not unreasonably, is going to be this kind of range high above market, right? You're kind of buying support and you're looking to sell the trouble area at resistance. Not unreasonable, okay? As you can see in this case, the market bounced at this level initially, but then got stuck at this weekly trouble area coming off of this low, okay? On these weeks here. And again, it looks very simple on the chart. It kind of gets stuck and then falls off. And it may seem that that's in some way unactionable, but here, really, if you look at the time frame, you've got price stalling at a nearby, very nearby level of resistance for 3 weeks before moving lower to retest the level. So again, if you, let's say, blindly bought the range low, for example, wouldn't be unreasonable, let's say on the first test or whatever it may be, going back to our management signals, if you want to be aggressive, you know that that's a decent chance to close the trade, or it's a sign that the market isn't ready to break out yet, okay? Or at the very least, we can expect a retest of our entry structure, which is what the market did here, and then found resistance, reclaimed. That part doesn't matter. You can see that this is a good example of getting management signals from trouble areas, okay? And we'll build on this as well, because then we'll talk about how that can actually give you trade entry triggers. I don't want to dwell too much on that now, but as long as you understand the kind of management framework, you're in good shape, okay? So we've got concepts, we've got the chart examples, and the hand-drawn examples as well. Hopefully that is somewhat clear. Okay, so just to revisit, if your high time frame idea is correct, price should be able to overcome usually lower time frame. You can see it's in brackets because the Bitcoin Cash example, that was a weekly trouble area before the next kind of big level. So it doesn't have to be lower time frame FTA for trade management. It usually is. Again, this will depend on the context and you exercising your discretion. But we know that if a market fails to break FTA, as in our examples, it's evidence that it's not ready to break out, and will likely revisit entry, and it's evidence of strength or weakness depending on whether price is at support or resistance. And we talked about the two signals that may generate. Getting out of the trade simply because that's not the type of move you want to see. It's not the type of area where you want the market to get stuck, or at the very least, you prepare for a retest of your entry structure. Okay, that's important. The second part of this, FTA for trade management, obviously the logical corollary of the market failing to break FTA. What happens if the market succeeds in breaking first trouble area? So pretty much the opposite of the diagrams we drew in the examples we covered. Well, that's evidence that your idea is on the right path. That's great. Specifically, it's evidence of weakness of FTA broken. That's the inverse, the opposite of what we talked about. Great. The juicy part, or the interesting part, is, again, the signals that are generated. You can compound or add to your position, which is quite aggressive. And again, the opposite of kind of getting out or closing the trade to some extent. You can move your stop loss to new invalidation at the FTA structure, which is important. And you could also just do nothing. Now, do nothing is a very interesting one. And again, it's context dependent. Let's say you're in a swing trade and price breaks the first trouble area. And let's say you're up. The swing trade was, 5-1 in terms of reward to risk. Saying it that way feels very strange, but let's say that the trade idea is 5-1 and the FTA breaks takes you to a 3-1, so you're up 3R, which should make sense if you watch the trade management and the risk management videos. Do nothing is really kind of context dependent. For example, do I think it's reasonable to do nothing if FTA breaks and it takes you up to 1R and it's just some evidence that your trade idea is developing correctly? I think it's reasonable to do nothing in those circumstances. What about if, as we discussed, the market, you've got a 5R trade, FTA breaks and you're up 3R, and it's a massive swing trade that could, take some time or take some heat, etc., etc. Is it as reasonable to do nothing when you're up that much and the market's moving as it is? Probably not. Okay, I don't want to turn this into a trade management video because fortunately there's already one on my channel, but do nothing isn't just like a free choice that you can just choose to do nothing and that's it. I think trade management should inform whether you have something to do or not. Okay? Now that we've covered both scenarios, you can kind of see what I was alluding to earlier with regard to two different FTAs at work. It's the take profit for the swing trade, which is where you exit the trade, and then there's the first reasonable obstacle between your entry and your target, where you manage the trade, right? So just to redo that diagram, let's take a bearish example for the sake of it, and draw that in red, and use some different time frames. So let's say this is a daily level, and we have a daily level resistance, got daily level of support, and then somewhere here, let's say a bit closer than we're used to. Let's do that in a different color to make life easier for us. Here we are. We have a intraday, and again, the time frame stuff, don't worry, there's a whole section on it. You have an intraday level of support. Okay? So what do I mean by two FTAs at work? Let's say you're getting involved on the trade, selling daily resistance. Now this, the 4-hour level, is FTA with regard to management, right? And this FTA, or this daily level, is your FTA with regard to take profit, okay? And again, this framework will be covered in detail. I hate how many times I've said that throughout this video. God forbid I have to do another recording. But the basic fact is, in a nutshell, if your trade idea is correct, that price will move from daily resistance to daily support, which is normally how it works, again, if you're right, is it reasonable to sell a level of daily resistance and fully take profit 100% of the time at a 4-hour level of support? I mean, maybe, but generally if we're swing trading, our working framework is that price will move from one high time frame level to the next high time frame level, and in doing so, in one form or another, break the level that is in between. Perhaps the absurd version of that will make the example clearer, where it's not unreasonable to have, you know, a weekly level, and then a 15-minute level, and then a daily level, and then an hourly level, and all these levels in quite close proximity to each other. Swing trading would be impossible by definition if you had to always take profit at FTA, no matter what the time frame, right? So let's say you have a weekly level of resistance, and then a little bit lower, like literally, I don't know, $10, $20, let's say on a Bitcoin move, you've got a 15-minute level of support. Let's say you sell weekly resistance, you get filled, and then you look at the chart and think, okay, where is FTA? And you've got a 15-minute level, literally a couple of dollars or very close to market. Do you think it's a reasonable swing trading framework to sell a weekly level only to cover it at a 15-minute support structure? Probably not, right? The whole basis of swing trading is you're making reasonable assumptions that price will move from one high time frame area to the next, and everything in between will get smoked, right? That's sort of the working framework. And if it isn't, as this absurd kind of example shows, swing trading would be almost impossible if you always sold high time frame levels only to ever cover them at literally the next level to price, or low time frame levels, etc., right? Now, going back to management, not to talk too much about the other sections of the video, this is the same sort of example, right? I said it would be a bearish one. So your trade is at selling daily resistance. Price comes into the first trouble area for management, which is your intraday, let's say, level of support. And then let's say you get some sort of price action developing in this area, whatever it may be. You get a push of the highs. Let's do like a break and retest scenario. And then the market starts pushing away. From a management point of view, what this price action is telling you is that your idea is most likely correct, right? There's a pull coming from the high time frame level. The price action at FTA is bearish, right? Lower highs, lower lows, support broken, just basically price going lower. And therefore, the signals that are being generated, as we talked about, the big ones at least, are kind of compounding your position. I don't have a video on that, but perhaps one for the future. And one, probably my more favored one, is managing the trade by moving your stop loss from wherever it was at the daily area to the price action that occurred at the lower time frame FTA, right? Now, yes, you sometimes unfortunately will get scenarios where you get a clear break of FTA, the market properly nukes it, runs away, and then, you know, swings all the way back to daily structure. I mean, that's just a small price. I mean, that's kind of the price you pay for managing the trade. It won't always work in your favor, but at the very least, you're probably up and securing some portion of the move at that point. I think it's suggestive of a good trading process, and at the very least, or perhaps the worst case scenario, quote unquote, you could always, depending on the price action and your rules, do business at the high time frame level again, and then maybe catch the free ride from one level to the next. Okay, but hopefully this framework so far has given you an idea of what I mean by FTA for trade management. Let me see if I've got anything particularly interesting on that point. I think we're fine so far with the BCH example. Okay. Now let me take a quick break. This will take 30 seconds. Free live streams and newsletter. There's no catch. Just check the description. Every Monday, Wednesday, and Friday on the Technical Roundup channel, you'll get either myself or Donald for 1 hour. And then the newsletter, which was previously paid, is now completely free. Comes out every Tuesday at 8 p.m. UTC. So go sign up, click all the links. It's just free content. So if you want more I know my upload schedule on this channel is terrible. So if you want something fixed and consistent, please go check out the links in the description. And I'd love to see you on one of the live streams or as a subscriber for the newsletter. Thank you very much. Let's get back to business. So we've talked about FTA for trade management. Let's talk about FTA for trade entry. Again, the second of the three, or the third? Yes, the third of the three use cases that we're going to be talking about. I hope I got that right. So what's the principle here? Well, when price is moving between, and again, all this kind of high time frame, low time frame stuff is in brackets because it's not, you don't need to use FTA in a purely high time frame swing trading framework, although that's where my experience is, and I think it certainly helps, right? Going back to it, when price is moving between high time frame levels and a trade at the high time frame level itself is unfavorable, a position can be established on a break of FTA. Okay? It's also valid if the market is in the middle of nowhere or between levels and you're waiting for price action or a break of FTA to get any conviction. The second one is almost easier to understand than the first one because you're essentially saying, well, the market's moving between support and resistance, kind of the middle of the range. I really don't want to do business here. If I get a breakout or a breakdown or price action, or price just needs to reach one of the structures where I want to do business, and then if I see buyers or sellers taking the initiative, then I'll get involved in the trade. Okay, so kind of 2-in-1 with regard to FTA for trade entry. It helps you both A, in doing business at levels where you may be uncertain, and B, keeping you out of shitty trades when the market's moving between levels. Okay, so an example of the underlying logic, I tried to articulate this in kind of a written normal sentence form, but a kind of conversation with a trader I thought got the concept across better. So as an example, this is obviously for the Bitcoin dollar chart. $6,000, and this is just made up charts anyway, it doesn't really matter. $6,000 is weekly support, but I'm not comfortable buying it given it has been tested too many times, right? So that's the bit where it's in the first point where a trade at the level itself is unfavorable, right? So 6K support, I'm not comfortable buying it given it's been tested too many times. I need more proof, right? This is the key concept with regard to FTA for trade entry. You're waiting for more proof to do business at, near, or from a technical structure. So if the move from 6K weekly breaks daily resistance at 6,300 FTA, I will enter a trade, right? So again, we can dissect this. Let me get my red pen out because red means important, obviously. So level itself is unfavorable. The position established in the break of FTA. So in this case, not comfortable buying it given it's been tested too many times. So the trade at the level, at the 6K level is unfavorable. So position can be established on a break of FTA. You're saying, I don't want to do business at 6K. I need more evidence. And what form does that evidence take? Well, if a weekly move manages to break daily resistance, and that daily resistance is FTA, that is good enough for me to take a position there. Okay? Hopefully that framework is somewhat understandable. And really, this is the closest I can articulate a non-charlatan or kind of convenient version of entering after confirmation. I think I've met very few traders, I mean, Trader SZ being one of them, and a couple of others who are at least very explicit about it. Confirmation generally with trading, when you read about it, is, I mean, if there was such a thing as clear confirmation of a trade, surely it would be very hard to lose money, right? Everyone would be making money trading because you either get confirmation and therefore you trade and make money, or you don't get confirmation and you don't trade and don't lose money. I mean, it's clearly not that simple, just the basic observational reality of how trading works, right? So this FTA break for trade entry is probably, I think, one of the more robust ways to articulate this concept without just making shit up. And again, the bullish and bearish examples, as in the underlying logic example, you want to buy a level of support if for some reason your conviction is not high, and that can be technical, that can be fundamental, whatever. If you don't want to do, or maybe it's not risk defined at the level, maybe there's a big inefficiency below market that you don't want to long into because you'll get slipped a lot if you're wrong, etc., etc. Millions of reasons. So if for whatever reason your conviction at the level is not high, you're essentially saying, look, this is support, I need more convincing. If this support is going to hold, it's going to have no problem breaking resistance. So therefore, I will enter not at support, but on the break of resistance. Okay? And the inverse obviously is true as well. So let's get our trusty diagram out again. Let's take a bullish example. And as you can see, this is kind of ties in very closely with management, right? That framework. So again, let's say this is our weekly to weekly. This level, let's say, is beaten up. Don't know how that means it's beaten up, but work with me here. And then you've got an interim level reasonably close to it as well. One casual observation I'll make is FTA for trade management levels tend to be a bit further away from structure than FTA for trade entry levels. So for trade entry, I normally like the FTA to be a bit closer or somewhat close to the structure where I want to do business itself. Whereas for management, if it's somewhere in the middle or between levels, that usually works out a bit better. Okay, so just to make that clear, so if I want proof that weekly support is going to do its job, it should have no problem breaking daily resistance. And ideally, I want these two levels to be quite close, so I know they're in the same area. Okay, whereas if I'm doing FTA for trade management, ideally I want a bit more breathing room on the high time frame level, and then for the where I manage the trade to be in an area where the market's already kind of moved significantly and it's kind of worth my attention. And that's something we'll talk about a bit more in the timeframes section of this video, okay? But again, going back to FTA for trade entry, if for whatever reason your conviction in the weekly level of support is not very high, you can say, yeah, I'd normally trade this level, but now I don't want to. What would convince me, and I know there's a nice objective above market where I want to do business, this weekly move, if it's going to pan out, should be able to break daily resistance. And again, this is where the concepts come in, essentially tied together. If a weekly move can't break daily resistance, then it's either a sign of weakness or a sign that the market, at the very least, isn't ready to break out quite yet. I don't want to deal with any of that. Break the level, I'll get involved. Until then, I don't think the probability of a successful trade at the level itself is particularly high. So what you're essentially saying, no to this, but yes to this. Right? I'll enter on the break of the level, and then you can do your whole pullback, confirmation, all that type of convenient stuff. But if this weekly move is to be trusted, it should have no issue breaking daily resistance. Now, the pros and cons, again, confirmation or higher probability is, I suppose, the pro, where you've avoided doing business at an uncertain level and waited for the probabilities or more evidence that you're correct. So I see that as a benefit. Of course, the con of that, or the downside, is that you're paying up. You're entering at a higher price to pay for that probability increase. So it's the premium paid so the confirmation or the peace of mind or the increase of evidence to support your trading thesis. You pay that by getting a quote unquote worse entry and paying up, right? Doing business here instead of here by waiting for this type of confirmation. So it's a trade-off just like anything else. Hopefully that makes sense. And obviously the opposite example of that as well. I want to sell level of resistance, conviction is not high. If this level is going to do its job, it should be able to break a nearby level of support, right? And that's what we talked about there. Now, let me see if I've got any particularly helpful... Oh yeah, of course I do. For the FTA for trade entry, a couple of useful charts in that regard. First of all, Bitcoin Cash. Going back to this again, we talked about how one of the FTA trade entry use cases was if levels are like particularly close to each other, or if the market is kind of in the middle of nowhere, or if you just want some breathing room between levels. This is a pretty good example. We're essentially saying, I ultimately want to trade to this level, and there's not enough space between A and B for me to take that on a swing basis. So for price right now, right, if this is where price is at the moment, where's the first trouble area? Where it's obviously this level here. So you could say, I don't want to rebuy the bottom range low level. It's been tested like 3-4 times. We've had a false break, retest. This level is messy. You know what? This whole range is messy. I don't want to do business here. Why don't you break the first trouble area? And then I know I've got a whole inefficiency to fill and a lot of space between A and B. So this again both provides and also shows the point that trade management and FTA trade entry are so closely linked. If you just get a sense that price is kind of cluttered or there's something in the way standing of a really good swing trade, why don't you just wait for that structure to break, and then sometimes the move you'll catch will be even quicker, right? So that's a good chart example of that. I think what I was trying to get across with the ETH BTC example is the FTA for profit taking, where we buy a level of daily support and we look to get out a level of daily resistance. Now, that's tougher to do in trending markets, not necessarily, but it just depends on the context and what price looks like. But certainly in a range, that framework is really good, where you've got highest close, a level of daily resistance, lowest close, a level of daily support. And you know that if you're getting involved in the trade or in the market at one side of the range, generally it's not a bad idea to get out on the other side of the range, until of course this type of thing comes around and you feel bad for taking profit at resistance, which you should not do to yourself. We can talk about that type of stuff, and we will actually in the time frame section that's coming up, but this is just a good example of we go from daily to daily. We stick to that time frame rule or time frame precedence that we talked about in the time frames video when using FTA for profit taking. Because again, if your idea is correct, price will generally travel from one structure to the next, right? And if it doesn't, as we talked about in the management section, then that in itself is a signal to either get the hell out, close, or at the very least stomach a retest of your entry. Hopefully you can see how this is all tying together. Oh, let me see. Is there another chart I wanted to talk about? No, I think that's... Oh, this is a good example, actually. Break of FTA, another concept, or the topic we talked about earlier with regard to the market floating between levels where you just don't think you have an edge, or you don't want to get involved outside of, price in the middle of a range. This is a really good example of that. The Bitcoin weekly chart right now. If you'll entertain this range, highest close resistance at 9.6, lowest close support 8.7. There's been some interesting developments on the daily time frame, but you can see on the weekly there's just, not much going on here. So an FTA trade or break of FTA approach, you'd say, well, look, I think there's attractive structures above market. Let's say there's 10.5 double top or even this old range here. Okay, so levels that are interesting above market and levels that are interesting below market. Let's say this kind of support resistance untested flip level at 7.6. But at the moment, all the market's doing is within this range. So a break of FTA would be my trigger to do business. That would mark a shift in participation, and then I know I've got really good levels that I want to trade towards, as opposed to spending weeks of price doing nothing. Okay, so this chart is also a decent example of FTA for trade entry. As we said, also valid if the market is in the middle of nowhere or between levels. Now my favorite section, and certainly one of the hardest ones to write, so please bear with me, FTA time frames, okay? I'll say it again, watch the time frames video. I wouldn't drone on about it if I didn't think it, if it really, trust me on this, go watch the time frames video. Now, FTA for profit, so the way I've structured the time frame section is those three concepts we talked about: profit taking, trade management, and trade entry. We're going to talk about how different time frames apply to all of those. Okay, so for those of you early on in the video who are wondering, is he just pulling this weekly, daily, in the middle, weekly? Has this come from his ass? The answer is not quite. There is some logic to it that we're going to cover here. Okay, if you've enjoyed the video so far, please leave a like, even a comment, any questions, helps me a lot. Thank you for your support. Let's get straight into it. So FTA for profit taking, how do timeframes influence that framework? FTA for profit taking is ascertained on the same time frame as the trade idea. This is our kind of base assumption, or at the very least my base assumption. Okay, so if I'm establishing a position at daily support, I'm going to look to take profit at daily resistance. And it's usually a reasonable level of daily resistance. So when I say reasonable, BCH is a really good example of that, where I don't really want to take a trade from this level, from support to resistance here, because it's just a bit tight and there's really not much space there. I'd much rather take a trade where there's a lot more space between entry and where I'm looking to get out. Okay, so that's what I mean by reasonable. Again, I wish you could copy paste all of this. I can give you a cookie cutter program, but I can't. A lot of this will depend on what the chart looks like and you exercising your discretion. But nonetheless, we can articulate a general framework, which is what we're doing here. E.g., if we're buying weekly support, FTA for profit taking is nearest weekly resistance. Now, the common mistakes, these are the ones you can definitely avoid. I still see this all the time, and I've been guilty of this in the past as well, and this is something covered in the time frames video, which is why this point exists. You need to tailor your expectations to the type of time frames and type of structures you're trading. So the common mistakes, and in this case I've outlined both extremes, is you're trading high time frame levels and you're trading crumbs at those levels. So let's say you're getting involved at weekly or monthly resistance, which, if your trade idea is correct, should lead to weekly and monthly time frame moves, which are necessarily big. We're talking large swings here, large swings from large levels. It doesn't make sense to trade crumbs at those levels, which goes back to the absurdist example we talked about, where you sell weekly resistance, amazing setup, and then price wicks down to M15 support, and you get the hell out and count your lucky stars. Now again, on a short term or a scalping or a day trading basis, there is absolutely nothing wrong with that. Kind of catching that impulse or catching the first test reaction, the first portion of that move, that's absolutely fine. But for our swing trading and the framework that we're using for this video, we generally want to avoid trading crumbs at high time frame levels, because then what's the point of trading high time frame levels at all if we're looking for swing trades, right? Which is why weekly to weekly, daily to daily, etc., we don't sell a weekly level only to cut it for $10 and get out at M15 support. If the weekly idea is correct, M15, hourly, 4 hour, all those levels should get obliterated until the next weekly structure, okay? And as you can imagine, the inverse of that is also just as bad, where you expect mushroom clouds or full-on crazy volatility and world-ending events from low time frame levels. Kind of price is in a 15-minute range and it breaks, breaks a trend line or something, and that's it. You're expecting a $2,000 swing down. Probably not particularly reasonable given where we are on the kind of time frame spectrum. So if you want to trade large, bigger moves, you should be more oriented towards the high time frame levels. If you are trading the lower time frame levels, you need to be cognizant of how much impact or perhaps the effect size they are most likely going to have. Okay? There's nothing worse than, let's say, shorting a 15-minute breakdown into a daily level of support without realizing and then getting instantly reversed on by the market. Okay? So that's important. And so with regard to FTA timeframes for profit taking, we generally stick to the same time frame for establishing those trade parameters, just to make trading actually actionable. Again, you'll see a lot of charts, and I'm sure some of your charts look like this, where you've just got levels just absolutely everywhere. Nothing really wrong with that per se. I generally recommend cleaning it up and focusing on the high time frames anyway. But if you do have a lot of levels next to each other, trading, and I mean swing trading certainly, but trading generally becomes impossible, because if you trade level to level, you're capturing like $2, $10, $15 moves, small percentages. There's probably really not much there. Okay, and the way you get around that, the way you fix being unable to trade your own chart, is by having an understanding of what can I reasonably expect from the time frame or the kind of structure price is reaching now. What can I expect from a weekly level? What can I expect from an hourly level? That sort of filters out a lot of the noise that might be in the middle between the two structures where you really want to do business. Okay? Now, how do timeframes apply to FTA for trade management? For trade management, again, slightly nuanced and tricky. It's usually ascertained on one time frame lower or on the same time frame for big swing trades, to some extent depending on the context. Okay, so if you have a monthly idea, the first trouble area for management would typically be on the weekly time frame. If you've got a weekly idea, the level for management would typically be derived from the daily time frame, and then if you've got a daily idea, typically derived from the intraday time frames. Now again, a couple of caveats or qualifiers. This isn't like a fixed rule. For example, you might have a weekly trade idea, and there's a fantastic trouble area on the weekly time frame in the middle for you to manage the trade. Now, generally, you'd use that for a take profit, but if price is really cluttered together, that may not be practical. And again, BCH is a really good example of that, where you've got a weekly level of support, a weekly level of resistance, and then just a nice kind of weekly structure on the opposite boundary, or where there's actually some space to formulate a swing trade. So in this case, you can see the FTA for management, which is this level here, is actually ascertained on the same time frame and not one lower as the trade idea, simply because it's so close to where the market is now. Okay, so it's not a fixed rule. It's not that you need to just suddenly jump off the weekly time frame and start looking at lower time frames. If anything, you start from the higher time frames and try to make sense of things. But just to bring you a good example of what this exception looks like, trade management, that middle structure where you manage a trade will generally fall on a or look like a lower time frame structure, but don't take it for granted that there's no equally valid structure on the same time frame as the BCH example has shown us. Now, again, this is a framework, so you must experiment with it because it's a balancing act, right? And what are you actually balancing? Well, if you give no low time frame consideration, then you miss important management signals, right? An example of that would be something we talked about earlier. So let's say this is our weekly level, this is our weekly level, right? And there's a nice daily level, again, the model we used earlier in the middle. Forgive me for not doing the colors. So if you completely ignore this in your analysis, and certainly if you're dealing with a greater risk-reward trade, I mean, forget the relative distances here, it doesn't really matter. If you pay absolutely no heed to low time frame considerations, and you take one extreme view of what's covered in this video, that, well, yeah, Cred said that price moves from weekly level to weekly level, so why should I give a fuck about this daily level? Well, it's because if you don't, you might miss out on some management signals that will tell you either to bail on the trade or at the very least to prepare for a retest of your entry, right? So that's one part of the equation that needs to be balanced, that if you give no low time frame consideration, that you will miss management signals that can inform your decision making with regard to the trade, or at least tell you what to prepare for. Okay. At the same time, excessive low time frame consideration will likely mean that you'll overmanage the trade or give too much weight to noise. And that brings the other example we talked about, where let's say your idea is that you've got a weekly level of resistance, a weekly level of support, price comes into the level, you buy it, okay, it does its thing, whatever, starts pushing away, and then there's like an hourly level here, okay, weekly, hourly, and let's say you get a bit of a wick at the level, like a slight pullback, and that's it, the world is over, you panic, you get out, you know, oh, it's an hourly FTA, that's it, the weekly idea must be totally wrong, you get out, and what a lot of the time happens, market will drift a bit lower, just react to the lower time frame first trouble area, and then continue to play out the high time frame move. Don't be the wick, I suppose would be the way to go through that. But hopefully, more importantly, you can see what I mean by the balancing act, where no low time frame consideration, you're essentially consigning yourself to fate and saying, I'm in God's hands now, I'll either get stopped out or hit take profit. As you'll know from the trade management video, I generally don't think that's advisable for most traders. At the same time, if you jump too many time frames, so let's say monthly idea, you manage on the 15-minute, or weekly idea, you manage on the 5-minute or the hourly, there's a good chance that the signals you're getting are almost not worth your time, or in no way materially affect or invalidate the high time frame trade that you're taking. Okay, so there's a balancing act, and you can see the framework I provided here I think is reasonably balanced, but as with anything, it'll have its own nuances and will be context dependent. So we've covered FTA for profit taking, FTA for trade management, FTA for trade entry. This is an interesting one. So for trade entry, I'd say it's ascertained on one time frame lower or on the same time frame for big swing trades, depending on the context, right? And BCH is just one example of when context may suggest that you use the same time frame. But generally, again, this is a balancing act. So as a rough starting point or framework for you to investigate, and this is kind of what I use. Again, depending on the context. With monthly structure, I'll look for a weekly or weekly entry or daily entry, right? With regard to waiting for a break of FTA, not trade entry, right? We're still talking about not opening the position, but in terms of looking at managing FTA, right? So for weekly structure, I'll look for a daily or intraday break of FTA, and for daily structure, I'll look for intraday break of FTA. And again, there's obviously some scope with regard to what intraday means, from the 4-hour upwards to the M5 to the M15. Let me just make that very clear, both for myself, but also for those reading the slides. Daily break of FTA. Okay, that's what we mean, because entry, using that term, can get a bit ambiguous. Well, you don't want to copy paste, that's fine. Or intraday, gosh, break of FTA. My fingers are fat. Okay, just to make that very clear. And as we covered in the BCH example, as per that bullet point, FTA for trade entry ascertained on the same time frame, usually if the area is crowded or not a lot of room between levels. The whole point of swing trading is generally there's a lot of space between one structure and the next. So if you see just a lot of crowding and, you know, high time frame levels in proximity to each other, making it uncomfortable to trade level to level, or there's just really not much of a move to capture, it's totally fine to use the same time frame if context permits it. Okay? I've said the second point a million times about guidelines and they don't work seamlessly, so exercise your discretion, and the wording is deliberate. These are just guidelines and stuff that I've discovered works well for me personally, but as discretionary traders, surprise, surprise, you'll have to exercise your discretion. And that's where we come back to the whole balancing act. If you go for blindly entry target stop with zero external factors or management cues, you ignore every other level but weekly support and weekly resistance, you know, even really nice looking levels in between, it's just all noise to you, you do nothing, either stopped out or take profit hit, you know, what, it's completely binary, very likely leaving something on the table there. And again, the other side of that sword is giving too much weight to low time frame signals. Like if you're swing trading on the weekly and price is moving in your direction, should you really be going apeshit over like a 5-minute level being bullishly reclaimed or something? Probably not, right? And that's something we elaborate in this slide as well, and some swing trading tips and clarifications. So hopefully, if I've done my job at least somewhat correctly, first of all, like the video, but we've refuted the idea that taking profit at FTA means it's impossible to swing trade, which is a very common criticism that I've heard and you see on Twitter and other places, that if you always take profit at the first trouble area, you can't catch big moves. I'd say the opposite is true, and that argument is based on a misconception, and it's one of the ones we talked about and drew out, where you buy weekly resistance and close at hourly support, which is what a lot of anti-FTA, whatever people, if there were such a thing, essentially believe that this system tells you to do. That's obviously not how it works. As you know, the base function, or on the base layer, we move from weekly to weekly, from daily to daily, from hourly to hourly, etc., etc. But we use interim or levels in between those high time frame structures to inform our decision making. That doesn't mean it's impossible to swing trade, because the trade parameters, the entry, target, stop loss, are based on high time frames. There's obviously going to be a ton of space, but FTA, as we've seen on lower time frames, can inform how we either take that trade if we're using FTA for trade entry, take profit if we're using FTA for take profit, or manage the trade if we're using FTA for trade management, right? So I've probably gone on for way too long about that point, but don't think that FTA means you can't swing trade. I'd suggest that the opposite is true. If anything, it's a framework to inform swing trading across all three facets: entry, management, and take profit. Okay, so if anything, the opposite is true. Second point, timeframes and context are crucial. Use common sense. I really hate that term, but these two examples hopefully get across what I mean by common sense. So for example, is it reasonable to derive strong views about a weekly timeframe swing trade based on a short-term reaction at M15 structure? Probably not, right? That should fail the kind of eye test for you and seem somewhat inherently unreasonable. Again, if you're kind of scalping or really short-term trading these high timeframe levels and you're just in for like one rotation or something, that's completely reasonable. But if we're trying to build swing trades here or be more skewed towards higher timeframes, that probably should insult your intellect in one capacity or another, right? Or just kind of sound wrong. At the same time, the opposite of that, is it reasonable to manage a daily timeframe swing trade if price gets stuck at, or breaks, again, context dependent, an outstanding 4-hourly level between your entry and your take profit? That's probably worth paying attention to, right? At least that's my belief. I missed the letter T here, so let me add that and we'll go back to the slide. So if you're trading first test, best test, and a reasonable FTA has not yet been broken, you should almost always be able to stomach a retest of your entry. That's really important. Don't put too much weight on the first reaction you get at a high time frame level. It is by no definition or by no sense conclusive, right? We'll talk about that in a second, but just bear that in mind. A quick point about timeframes before we go back to the first test, best test stuff, because that's something I've been asked a lot about as well. So timeframes are not mutually exclusive. Hopefully that's obvious from some of the examples and just how you draw your levels generally. But for example, a weekly area is also likely a daily area, etc., etc. So how do you go about that? How do you classify these levels? Certainly if you're trying to follow the time frame guidelines, I just say always defer to the higher time frame. So if you've got just a level in the market, and it's visible on the 4-hour, great. It's also visible on the daily, great. And then on the weekly, it's kind of just in the middle or just like in a wick, or it doesn't have that same significance. Then just call it what it is, which in my view, I'll just call that a daily level, right? So defer to the highest time frame on which it is clearly visible, but no higher. Now, going back to the point about first test, best test, I've tweeted about this, and I'm sure all of you have experienced similar scenarios where you enter at a high time frame level, price reacts nicely, you move your stop to break even, and then price retests the high time frame level. You obviously close your trade or get stopped out because you moved it to break even, and the high time frame move materializes, except it is without you. So this is a good example, right? Forgive the probably blurry diagrams here, but let's say this is our high time frame level of resistance. Okay, you get involved at the trade at the level, the market moves in your favor, which is fantastic. And obviously what you do to feel good, especially usually you'll have like some really scary looking like engulfing candle here or something that really makes you confident in the trade. Normally you'll see traders just put their stop. I think Tom Dante's got an extremely similar diagram to this, which I tried to find but couldn't, and also just learned the concept of FTA there and hopefully built upon it from that point. So obviously, I mean, if you watch my videos, you've seen Tom's stuff, and there are no surprises there. Going back to this, your stop moves to break even because you feel good, the candle's scary, and the level's done its job. What price will often do, or sometimes do, then bounce at a lower time frame first trouble area, not unreasonably, right? It doesn't mean the market's reversing, but as we talked about, at the very least, it means you should be able to stomach a retest of your entry. But because you move to break even, you're unable to stomach a retest of your entry. All price does is retest the high time frame structure, which you're now technically buying with your stop loss as opposed to selling, and then the high time frame move materializes and breaks first trouble area in the process. Okay, so that early point, very early point that I made about being able to usually stomach a retest of your entry, certainly before a time that FTA has been broken, that's just something you should be prepared for. And which is why I generally almost never encourage swing traders to move their stop or adjust their parameters based on the very, very first reaction that a market gives to a high time frame level. And this is something we elaborate on the time frames video. But if you're, for example, selling a weekly level of resistance, which let's say it reverses relatively quickly, right? Like a 1 weekly candle and then it reverses, it could still be retesting that level on an intraday basis. There's, 7 days in the week. There could be numerous or seemingly endless retests on lower time frame of that same level. It might still play out very clearly on the higher time frame, but if you give too much weight to those retests or you're too aggressive in managing the trade from the very first reaction, there's a good chance that you get chopped up or stopped out before the high time frame move plays out. More on this in the time frames video. Hopefully you've watched it if you're listening to this, so I won't repeat myself on that matter, but certainly keep that swing trade graveyard pattern at the bottom of the slide in your mind. Conclusion. So the concept of FTA is a versatile tool. As we've hopefully established, we can use it for take profit levels and establishing some sort of replicable system or logic for that. We can use it to manage the trade and inform the trade we're already in, whether it's going corrupt, whether it's going in our favor, it's going against us, whether we should prepare for our entry to be retested, and we can stomach that. All of that sort of information with regard to trade management is very useful. And also just for trade entry, the concept of FTA, again, isn't just purely for when you're already in a trade. Where do I set take profit? How do I, manage it? It can also actually be the trigger for trades when the market's in the middle of nowhere or in some form or other, as per the BCH example or the Bitcoin weekly example charts we talked about. The break of FTA can itself put you in a favorable trade compared to where the market has been spending some time. Okay? So like most concepts in the technical analysis series, these are guidelines to develop a framework and better inform the way you exercise your discretion as traders. I really wish I could just make a printout PDF that you can just transplant and use mechanically and, copy-paste type of thing. Unfortunately, I've just found that's not what works for me. It's not how I trade or think about markets. But applying personal experience and nuances and edges to broad, reasonable guidelines is where I found my success, so that's kind of what we're trying to do here. Context is king, convenient phrase, and this next one sounds particularly cringe, But bear with me, all we're doing is using a framework that can cater for the intrinsically dynamic nature of a moving market, right? But the basic point, and hopefully that's particularly clear now that you've made it to the end of this video, is that if all we ever had to do was entry, target, stop loss ad infinitum, then we'd all be rich, right? There seems to be more depth to trading and to markets than just that type of approach. At least that's my belief. At the very least, if you disregard most things in this video, we've articulated a consistent framework for profit taking that you can use, so no harm, no foul done there. Well, that's it. Like the video if you learned anything, even one thing. Very much appreciate support on these. Also, we're almost at 50k subscribers. Given my non-existent upload schedule, that is insane. I'm grateful for all of you, and as you can see, the content is still coming, and there are plenty of that to follow. As mentioned midstream, I rudely interrupted my own teaching. Live streams on Technical Roundup, which is the name of the YouTube channel, links in the description, are every Monday, Wednesday, Friday at 7 UTC. I do the Monday session, Donald does the Wednesday session, and Fridays we do something fun. Sometimes I do it solo, he does it solo, we bring some guests. Still a good place to be on a Friday night. I know that sounds sad. And the Technical Roundup newsletter, which was previously paid, is now also free, and all you have to do is just sign up to a mailing list, standard style, and that comes out every Tuesday at 8 UTC. So no shortage of content by any means. Any questions, comments, feedback, anything at all, I always love to hear from you, even if it's 1 or 2 words. Leave them in the comments section below. Check out the links in the description for further educational material, live streams, shenanigans, content generally. Thank you for your attention. Hopefully you've learned something. That's all from me, and I will see you hopefully on one of the live streams or in the next technical analysis series video on this channel. Thank you. Take care.